2020, large cap index went down by 33% in just 2 months. And I see a lot of people regret of not investing at those COVID times because in just 6 months, markets recovered and gave a return of 50% to its investors. What if I told you that small cap stocks are still trading at the same valuations? Look at it yourself. Look at the PE ratio of S&P BSE Small Cap Index. You will find that small cap companies are still at valuations very close to COVID levels. Let us understand why is that. So first of all, companies are affected by inflation. Look at this WPI data where inflation was over 16% in the month of May and June. The inflation was highest ever in last 20 years. And this trend of inflation has impacted the companies adversely as they cannot pass on the cost very easily and their margins take a hit. Look at this graph. Here, WPI captures the production side inflation while CPI captures price change at the consumer level. So the gap between WPI and CPI index is the burden which is borne by the manufacturing companies. When wholesale index was at around 15%, consumer price index was around 7%. This shows the lag in passing the cost to the customers, which was ultimately borne by the companies. Even when they pass on the cost, their margins are impacted adversely. Let me show you how. Suppose there is a company with revenues at 1000 crores and operating expenses at 900 crores. Thus, operating profit margin for this company is 10%. Now, what happens is, suppose expenses increase by 10 crore and increase to 910 crore. So, company decides to recover it from the customers, increasing the revenue also by 10 crore. You will notice that operating profit remains same on absolute terms, but operating profit margin has reduced. Rising inflation has other impacts also, because in order to curb the inflation, RBI has to increase interest rates, which makes FDs more lucrative and thus drives away investors from the stock market. Now, increasing interest rates also means increasing finance costs for the companies, which again adversely impacts their margins. In last few years, small cap companies were affected by many unexpected factors. So we've seen many small cap companies who have announced capex plan even before COVID, and then they had to postpone their plans because of frequent lockdowns and availability of raw material. And when finally the capex was completed, the plants were still not operating at full capacity due to no demand. So the inflationary pressures have caused a blip in demand of goods and services, as a general increase in cost means that some of it has to be passed on to the consumers. So all these factors are driving the share prices down and thus resulting in low valuation. So is it the right time to invest? Now if you look at the returns of last 3 years, small cap indices have given a return of around 177%, while large cap indices has given a return of around 90%. This difference is because the small cap companies are in the growing stage and they have the potential of giving multifold returns to its investors. Now, when small cap companies come with the potential of giving multifold returns to its investors, they also come with the highest risk.
Remember, with great power comes great responsibility.
Because in last 1 year, when things haven't been best for the economy, large cap indices took a dive of 1%, while small cap indices went down by 4.5%. And thus it becomes essential that you invest your money in only fundamentally strong stocks. And in order to take advantage of the low valuations, you can subscribe to our small case compounders portfolio, which has historically performed better than the indices and is currently available at even lower valuation than the indices. Investment in securities market are subject to market risk. Read all the related documents carefully before investing.